All right, so are you ready? Today we're gonna be we're taking a deep dive into the world of Forex.
Forex.
Forex, which is that
Yes.
mysterious realm where trillions of dollars,
Trillions.
yeah, trillions of dollars change hands every single day. Now, I think even if you're not planning to become a day trader,
Right.
understanding the basics of Forex can actually give you a surprising edge in
Absolutely.
navigating the global economy.
You might be surprised how much Forex impacts your everyday life, even if you never place a trade yourself.
Okay, that definitely piques my curiosity. So first things first, can we demystify what Forex actually is? It's not the same as like playing the stock market, right?
You're right, it's a different beast altogether. So while the stock market deals with buying and selling shares of companies, Forex is all about trading currencies, US dollars, euros, Japanese yen, you name it.
Okay.
It's basically a massive global marketplace where the product being bought and sold is money itself.
So instead of investing in like Apple or Tesla, I could be trading euros for dollars.
Exactly. And unlike the stock market, which operates on specific trading hours, the Forex market is open 24 hours a day, 5 days a week. As one trading day ends in, say, New York, it's just getting started in Tokyo.
So it's like a never-ending financial party,
That's right.
hopping time zones. But I'm picturing those currency exchange booths you see at airports. Is it really similar to that?
There are definitely some parallels. But here's a key difference. In Forex, currencies are always traded in pairs. So you're not just buying dollars, you're buying dollars against another currency,
Okay.
essentially betting on the relative value of one against the other.
Okay. I think I'm starting to get it, but can you give me a concrete example? I'm a learn by doing kind of person.
Sure. Let's take the euro and the US dollar, one of the most commonly traded pairs. It's written as euro USD. If you believe the euro will gain value against the dollar, you would buy that pair. Conversely, if you think the dollar will strengthen, you would sell euro USD.
So in essence, I'm speculating on which currency will be the winner in that matchup.
Precisely. You're trying to anticipate which currency will appreciate or depreciate relative to the other.
This is already making my brain work in new ways. So what if I wanted to trade, say, British pounds against Japanese yen?
That would be the GBP-JPY pair, and the same principle applies. It's all about predicting the shifting values of currencies in relation to each other.
All right, I think I have a handle on the basic concept, but I'm guessing there's a whole dictionary of Forex lingo I need to learn
Absolutely.
before I even think about placing a trade.
You're not wrong. And to really navigate this world, you need to understand some key terms. One you'll hear constantly is PIP, which stands for point in percentage. It's the smallest unit of movement that a currency pair's price can make.
So if a pip is the smallest unit, is it kind of like the cents in a dollar, but for currencies?
You got it. For most pairs, a PIP is 0.0001. So if the Euro USD pair moves from 1.1 thousand to 1.1001, that's a 1 pip change. Understanding pips is crucial because it helps you calculate potential profits and losses on your trades.
Interesting. I can see how even a tiny movement could make a big difference when you're dealing with large amounts of money.
Absolutely.
Okay, what about this term I've heard, spread? What is spread?
The spread is basically the difference between the buying price or the bid and the selling price or the ask of a currency pair. Think of it like a small fee that goes to the broker for facilitating your trade.
Hmm,
The smaller the spread,
yeah.
the better it is for you as a trader.
So finding a broker with tight spreads is like snagging a good deal on commission fees.
Exactly. It means more of your potential profit stays in your pocket. Now, there's another term that can be a bit more complex, leverage.
Leverage. Leverage sounds a bit intimidating. What does it mean in the context of Forex trading?
Leverage is a tool that allows you to control a much larger position in the market than your actual account balance. It essentially lets you amplify your potential profits, but also your potential losses.
So it's like I'm borrowing money to trade with. Sounds like it could be risky.
It definitely is. It's important to remember that leverage magnifies both wins and losses. For example, with 100.1 leverage, which is quite common in Forex, you could control $100,000 worth of currency with just $1,000 of your own capital.
Wow, that's a powerful tool.
It is.
But I can see how it could quickly turn against you if you're not careful.
Absolutely.
So if leverage is like borrowing money, what exactly is margin?
The margin is the amount of your own money that you need to set aside as a security deposit when you open a leveraged position. It's essentially collateral that the broker holds to cover potential losses on your trade.
Okay, so it's like a safety net for the broker
Exactly.
in case my leverage trade goes south.
Exactly. It ensures that they're covered if your losses exceed your initial investment. Now, there's one more term we should cover before we move on: lot size.
Lot size, is that like how much of a currency I'm buying or selling?
You're on the right track. In Forex, currencies aren't traded in single units like stocks. They're bundled into lots. A standard lot is 100,000 units of the base currency. So if you were to buy one lot of USD, You'd be trading 100,000 euros.
100,000 euros. That's a lot of euros. What if I didn't have that kind of money to throw around?
Don't worry. For traders with smaller accounts, there are mini lots of 10,000 units and micro lots of 1,000 units. This allows you to participate in the market without needing a huge amount of capital up front.
That's good to know. Okay, I think we've officially tackled the Forex glossary for now, but the big question is, how do people actually make money trading currencies? Is it all just guesswork?
Well, it's certainly not random. At its core, Forex trading involves speculating on which way a currency pair's value will move.
Okay,
If you think a currency will strengthen, you buy. If you think it will weaken, you sell.
so it's all about trying to predict the future of currency values. Do successful traders have some kind of crystal ball?
While a crystal ball would be handy, Forex traders rely on two main methods of analysis: fundamental and technical.
Ooh, that sounds intriguing. Can you break down these two approaches for me?
Sure, fundamental analysis is like being an economic detective. You're looking at real-world events, things like interest rates, economic reports, political stability, even natural disasters, to figure out how they might impact the value of a currency.
So if I'm following you, if a country's central bank decides to raise interest rates, that might make its currency more attractive to foreign investors,
Yes,
leading to an increase in its value.
exactly. Or let's say there's a major political scandal in the country. That could make investors nervous, potentially causing its currency to weaken. Fundamental analysis is all about connecting the dots between world events and how they might shift the balance of power between currencies.
Okay, I can see how that would take a lot of research and awareness of what's happening globally.
Definitely.
But what about technical analysis? Is that where we get closer to the crystal ball territory?
Not quite. Technical analysis focuses on studying price charts and looking for patterns and trends that suggest where the price might be headed next. Think of it like trying to understand the personality of a currency pair based on its past behavior.
Honestly, when I look at those charts, they just seem like a bunch of lines and squiggles. How can you possibly find meaningful signals in all that chaos?
It definitely takes practice. Technical analysts use a variety of tools such as moving averages, trend lines, and oscillators to identify potential entry and exit points for trades.
So instead of trying to predict the future, they're looking for clues in the past to make educated guesses about what might happen next.
Precisely. And many successful traders use a combination of both fundamental and technical analysis to gain a more well-rounded perspective.
Okay, I'm starting to see how much strategy and analysis goes into Forex trading.
Absolutely.
It's definitely not as simple as just picking a currency and hoping for the best. Which makes me wonder, what are some of the risks involved? I'm guessing it's not all sunshine and roses.
You're right, and that brings us to a crucial point: the ever-present element of risk and reward in Forex trading.
Okay, here's where it gets really interesting. I have a feeling this is where things can get a bit wild.
The Forex market is known for its volatility, which means prices can swing up and down dramatically, especially during major news events or economic releases.
So even if you do my research and analysis, there's still a chance that things could take an unexpected turn and I could end up losing money.
Absolutely. That's why managing risk is an essential part of being a successful Forex trader.
Okay, that's a bit sobering. So what are some practical ways to manage risk and avoid losing your shirt in all that volatility?
One of the most important tools is a stop-loss order. Think of it like setting a safety net for your trades. It allows you to predetermine the maximum amount you're willing to lose on a particular trade.
So if I'm buying USD and I set a stop loss order, it will automatically sell my position if the euro falls below a certain price, preventing me from losing more than I'm comfortable with.
Exactly. It helps limit your downside risk. Another key to managing risk is avoiding the temptation to over-leverage. Remember that example of 100.1 leverage? While it can boost your profits, it also magnifies your losses if a trade goes against you.
Right, kind of like stepping on the gas pedal when you're driving on ice, things could be out of control quickly.
A very apt analogy. Another important strategy is diversification.
Wait, isn't diversification something you do with investments, like spreading your money across different stocks and bonds?
You're absolutely right, and the same principle applies to Forex trading. Don't put all your eggs in one basket, or in this case, one currency pair. By diversifying your trades across different currencies, you're spreading your risk and reducing your exposure to any one particular market fluctuation.
Okay, that makes a lot of sense. It's like that old saying, don't bet the farm on a single hand of cards. Any other words of wisdom when it comes to navigating the Forex market?
One of the most important things is to stay informed. Keep an eye on economic news, political events, and global happenings that could influence currency values.
Got it. No trading in a vacuum. Knowledge is power, especially in a fast-paced market like Forex. So let's say someone listening to this deep dive is intrigued enough to consider taking the plunge. What would be the first step?
The first step is finding a reputable Forex broker. Think of it like choosing a bank for your money.
So choosing a broker is kind of like picking a financial partner. What should I be looking for?
Look for a broker that is regulated by a recognized financial authority. offering transparency and security. Compare spreads across different brokers to ensure you're getting competitive rates. And don't underestimate the importance of a user-friendly trading platform.
So it's not just about the fees, the trading platform itself can make or break the experience.
Exactly. It's where you'll be spending most of your time, so you want it to be intuitive, reliable, and offer the tools and features you need.
Makes sense. Now, once I've found a trustworthy broker, do I just jump right in with real money and start trading?
Hold your horses. Before risking any hard-earned cash, take advantage of the demo accounts that most brokers offer.
Ah, so it's like a Forex training ground where I can practice with virtual money. That takes the pressure off.
Exactly. A demo account lets you experience real market conditions and test out different strategies without any financial risk. Use this time to get comfortable with the platform, experiment with order types, and see how you react to price fluctuations.
Great advice. So once I've honed my skills in the demo account, what's the next step? Do I just wing it and see what happens?
Not quite. Before you dive into live trading, it's essential to develop a solid trading plan. This isn't just about picking which currency pairs to trade, it's about defining your goals, your risk tolerance, and your overall approach to trading.
So it's like having a roadmap for my Forex journey. No wandering aimlessly through the currency wilderness.
Precisely. Your trading plan will guide your decisions, helping you stay disciplined and avoid emotional impulses.
Okay, I'm sense of a theme here. Taplin seems to be a major key to success in Forex trading.
You're absolutely right. And starting small is always a good idea. There's no need to go all in right away. Begin with smaller position sizes as you gain experience and confidence.
So ease into it gradually, kind of like testing the water temperature before jumping in the pool.
That's a great way to put it. Remember, Forex trading is a marathon, not a sprint. It takes time, patience, and continuous learning to become consistently profitable.
Well said. I think that's a perfect place to pause for part one of our Forex deep dive. We've covered a lot of ground, from the basics of what Forex is to essential terminology, the importance of risk management, and choosing a broker.
We've also touched on the different approaches to analysis and the vital role of a demo account and a solid trading plan. But this is just the beginning of our journey.
Stay tuned for part two, where we'll explore specific trading strategies and delve deeper into the psychological aspects of navigating the Forex market. Welcome back to our deep dive into the world of Forex. I have to admit, after that first part, I'm already feeling a bit more confident just knowing the lingo
That's great to hear.
and the basic concepts.
Yeah,
But now it's time to shift gears and explore how to actually put that knowledge into action
right.
with some specific trading strategies.
Absolutely.
Okay, I'm all ears, but before we get into the nitty-gritty, can we back up for a second? You mentioned earlier that Forex trading is a skill, not just a game of chance.
Absolutely. And like any skill, it takes practice, discipline, and continuous learning to master.
So for someone who's just starting out, what are some practical tips for developing those skills? How do you go from being a demo account newbie to a more confident and disciplined trader?
One of the most valuable things you can do is to keep a trading journal.
A journal. Is that like, Dear Diary, today the USD made me cry?
Well, there could be emotional ups and downs for sure. But a trading journal is more about systematically recording your trades, the reasoning behind each decision, and the outcome, whether you made a profit or a loss.
So it's like a way to track my progress,
Yeah,
identify patterns in my trading, and figure out what's working and what needs improvement.
exactly. By analyzing your past trades, you can spot recurring mistakes, refine your strategies, and make better decisions in the future. It's like athletes reviewing game film to study their performance and identify areas for growth.
That makes a lot of sense. Okay, trading journal check. What else is crucial for a beginner trader to keep in mind?
Another key is to stay disciplined and stick to your trading plan, the roadmap we talked about earlier.
Right, but why is having a plan so important?
Because the Forex market can be very tempting. It's designed to play on emotions, fear, and greed in particular. If you let your emotions dictate your trades, you're more likely to make impulsive decisions that can lead to big losses.
Ooh, that's an interesting way to think about it. So it's almost like a mental game as much as a financial one.
Precisely. Developing what's called emotional intelligence as a trader is just as important as understanding technical indicators or fundamental analysis.
Wow, I'm starting to see Forex trading in a whole new light. So how do you actually develop emotional intelligence when it comes to trading? It sounds a bit abstract.
It starts with self-awareness. Take some time to recognize your own emotional triggers and how they might affect your trading behavior.
So if I tend to panic and sell as soon as a trade dips a little,
Yeah,
that's something I need to become aware of and try to manage.
exactly. And on the flip side, if you get overly excited when a trade goes your way and start chasing even bigger profits, that can also lead to poor decisions. Having a clear trading plan, setting realistic goals, and practicing patience are all crucial for maintaining emotional balance in the often turbulent world of Forex.
Okay, I already feel a bit calmer just thinking about being more mindful and aware of my emotions. So we've talked about the psychological side, but now I'm curious about the practicalities of timing. Are there certain times of day or days of the week when the Forex market is more active or volatile?
That's a great question. Because the Forex market is decentralized and operates 245 across different time zones,
Right.
there are definitely periods with higher trading volumes and what we call liquidity.
Liquidity, is that like how easy it is to buy or sell a currency pair without causing a big price swing?
You got it. High liquidity means there are lots of buyers and sellers active in the market, making it easier to execute trades quickly and at favorable prices.
So when are these magic hours of high liquidity I should be aware of?
Typically, the most active trading periods are when the major financial centers, London, New York, and Tokyo, are open simultaneously. Those overlapping hours tend to see the highest trading volume and often the most price movement.
So if I'm in New York, should I set my alarm for 3 a.m. to catch the London opening bell?
Well, you don't have to become a night owl to be a successful trader, but it is good to be aware of those overlap periods, especially if you're looking for potential short-term trading opportunities.
Makes sense. Are there any specific days of the week that tend to be more volatile than others? Should I avoid trading on Fridays or Mondays, for example?
It could definitely vary depending on economic calendars and news events, but generally speaking, Tuesdays, Wednesdays, and Thursdays tend to be the most active trading days.
So the middle of the week is where the action is. I'm guessing weekends are pretty quiet, though.
Yes, the Forex market is officially closed on weekends, but that doesn't mean things completely freeze. In fact, weekends can present unique challenges and opportunities for Forex traders.
Interesting. How so? If the market is closed, wouldn't everything just stay the same until it reopens?
Well, the world keeps spinning even when the Forex market takes a break. News and events can still happen over the weekend, and this can lead to a gap in prices when the market reopens on Sunday evening.
So you're saying those weekend events can build up pressure, like a coiled spring that gets released when trading resumes?
Exactly. That's why it's crucial to stay informed even during the weekend. Be prepared for potential price gaps or increased volatility when the market comes back online.
Got it. No tuning out completely on the weekends. Okay, so we've talked about discipline, emotional intelligence, and being aware of market hours and liquidity. But what about actually deciding which currency pairs to focus on? Any tips there?
Choosing the right currency pairs is an important part of developing your trading strategy. Some traders prefer to stick with the major pairs like USD, GBP USD, or USD JPY. These pairs tend to have the highest liquidity and tightest spreads, making them generally more stable and less prone to wild price swings.
So the majors are kind of like the blue chip stocks of the Forex world, more reliable, but maybe not as exciting?
You could say that. They're a good starting point for new traders who are still getting their feet wet.
But what about traders who are looking for more action and potential for bigger wins? Are there more volatile pairs they could explore?
Absolutely. Traders with a higher risk appetite might be drawn to what we call exotic pairs. These involve currencies from emerging markets, which tend to be more volatile and less liquid than the major pairs.
Exotic pairs? That sounds exciting. Give me some examples.
Sure, exotic pairs might include currencies like the Mexican peso, the South African rand, or the Turkish lira. They can offer more opportunity for profit, but also carry higher risk.
Okay, those definitely sound more adventurous than trading euros or dollars, but I'm guessing they come with a higher chance of losing money as well.
You're right, exotic pairs can be much more unpredictable. They're less liquid, so spreads are wider, and price swings can be more dramatic. It's like the difference between navigating a calm sea versus riding a wave on a surfboard.
Okay, I'm getting the picture. Higher risk, higher reward, gotta choose your currency battles wisely. So once a trader has decided which pairs to focus on, what's the next step?
The next step is where the real analysis begins. We need to delve into the world of fundamental and technical analysis to identify potential trading opportunities.
Right, back to those two main methods for trying to anticipate price movements. Can you remind us again of the key differences between the fundamental and technical approaches?
Of course, fundamental analysis, as we discussed earlier, is all about understanding the underlying economic and political factors that drive currency values. You're looking at things like interest rate decisions, economic growth reports, political stability, and even geopolitical events to figure out how they might influence the relative strength or weakness of a currency.
So it's like being a global news junkie with an economic lens.
That's a great way to put it. You have to be in tune with what's happening around the world and how those events might shift the balance of power between currencies.
And technical analysis, if I remember correctly, is more about looking for patterns in those cryptic price charts.
Precisely. Technical analysts believe that past price data can reveal trends and patterns that can be used to predict future price movements. They use a variety of tools and indicators to try to decode those patterns.
So it's like those people who can spot hidden images in those 3D magic eye posters. They're seeing things in the charts that the rest of us might miss.
Haha, that's a pretty good analogy. Technical analysts are looking for those subtle clues that suggest where the price might be headed next.
This is all fascinating, but I have to ask, is one approach better than the other, or do most traders use a combination of both?
There's no one-size-fits-all answer. Some traders swear by fundamental analysis while others rely solely on technical analysis. But many successful traders use a blend of both, combining the insights gained from economic and political events with the signals and patterns found in price charts.
So it's like having multiple tools in your toolbox. You choose the right one for the job at hand.
Exactly. The key is to find a trading strategy that resonates with your personality, your risk tolerance, and your overall trading goals.
I love that. It makes Forex trading seem more like an art than a rigid science. And on that note, I think this is a great place to wrap up part 2 of our Forex deep dive. We've explored the importance of discipline, emotional intelligence, and choosing the right currency pairs. We've also revisited those two key approaches to analysis, fundamental and technical.
And in our final part, we'll dive even deeper into specific trading strategies, the types of orders you can use, and how to manage risk effectively to protect your capital.
I can't wait. See you back here soon for the grand finale.
All right, we're back for the final part of our Forex deep dive. I'm really starting to see why people are drawn to currency trading after learning so much about it.
Absolutely.
In the last part, we talked about fundamental and technical analysis, but I'm still a bit fuzzy on how those approaches actually translate into real-world trading strategies.
Yeah.
Like, how do you go from spotting a pattern on a chart or reading an economic report to actually pulling the trigger on a trade?
That's a great question, and it's where the art and science of trading really come together. There are countless trading strategies out there, each with its own set of rules and techniques. Some traders gravitate towards short-term strategies like scalping or day trading, where the goal is to profit from small price fluctuations that happen within a single trading day.
So scalpers are like the sprinters of the Forex world.
Yeah,
In and out of trades quickly. That's a great analogy. Scalpers often hold trades for just a few seconds or minutes, trying to capture tiny profits from those rapid price movements. They're all about speed and precision.
wow, that sounds intense. It must take nerves of steel to be a scalper. What about day trading? Is it similar, just on a slightly longer timescale?
Day traders also aim to open and close all their positions within the same trading day, avoiding holding any trades overnight. They might ride trends that last for hours, taking advantage of intraday volatility.
I see. So no checking your phone in the middle of the night, worrying about what's happening to your trades. Now, for someone like me who's a bit more risk averse, are there some strategies that don't require such constant attention?
If you're looking for a more laid-back approach, you might explore swing trading or trend trading strategies, which involve holding trades for longer periods,
Okay.
from days to weeks or even months.
So swing traders and trend traders are like the marathon runners of Forex. They're in it for the long haul, aiming for those bigger gains over a longer time frame.
Exactly. Swing traders try to capture profits from price swings within a larger trend, while trend traders aim to identify and ride the momentum of major trends that can last for weeks, months, or even years.
Okay, I'm starting to get a sense of the different personalities that exist within the world of Forex trading. But even if I know which strategy I want to use, how do I actually know when to enter or exit a trade? That feels like the million-dollar question.
You're right, that's where your analysis skills come into play. It's all about using your knowledge of technical indicators and price action to try to anticipate those key turning points in the market.
Can you give me a specific example, like how a technical indicator might signal a good time to buy or sell? I need something to really wrap my head around this.
Sure, let's take the moving average crossover, which is one of the most popular indicators among traders. When a shorter-term moving average crosses above a longer-term moving average, it can be seen as a potential buy signal, suggesting that upward momentum is building.
Okay, so it's like two ships passing in the night, and when the faster ship overtakes the slower one, it's a sign that the tide is turning in favor of the bulls.
That's a great visualization. And conversely, if the shorter-term moving average crosses below the longer-term average, it could be a sell signal, suggesting that the bears are taking control.
Got it. So it's all about recognizing those key moments of transition, those crossovers where the power dynamic shifts. Now, what about price action analysis? I know we touched on it briefly, but can you explain a bit more about how that works?
Sure, price action traders focus on reading the story told by the price movements themselves without relying too heavily on indicators.
Okay.
They look for patterns like breakouts, reversals, and support and resistance levels to try to anticipate where the price might be headed next.
This is starting to feel like we're learning to crack a secret code, but I have to be honest, it all sounds a bit too good to be true. There's no way to predict the future with 100% accuracy, right?
Right.
Even the most skilled traders must make losing trades from time to time.
You're absolutely right. No one can predict the market perfectly. There's always an element of uncertainty, and even the most experienced traders make mistakes. That's why having a robust risk management plan is absolutely crucial.
I knew it. It's not all easy money, even if you know what you're doing. We talked about risk management earlier, but can you remind me of some key principles? I think I need a refresher.
Sure, the first and most important rule of risk management is to never risk more than you can afford to lose. It sounds simple, but it's easy to get caught up in the excitement of trading and overextend yourself.
Yeah, it's like that feeling when you're at the casino. You can get carried away and suddenly you've bet more than you intended.
Another crucial element of risk management is using stop-loss orders on every single trade. We talked about stop losses before, but it bears repeating. They're like setting a safety net to protect your capital from catastrophic losses.
Right, it's like having insurance on your trades. What else should we keep in mind when it comes to risk?
Don't underestimate the power of diversification. This is one of the most fundamental principles of investing, and it applies equally to Forex trading. By spreading your risk across different currency pairs, you're less vulnerable to any single market event.
So it's like that old saying, don't put all your eggs in one basket?
Exactly. If you're overexposed to one currency pair and something unexpected happens, a surprise economic announcement or a geopolitical event, you could be in for a rude awakening.
Okay, diversification, stop-loss orders, and keeping those emotions in check. I'm starting to feel like I'm building a solid risk management toolkit. But now I'm curious about the practical steps involved in actually executing a trade. What are the different types of orders I can place?
The two most basic order types are market orders and limit orders. A market order is an instruction to buy or sell a currency pair immediately at the best available price in the market.
So it's like saying, just get me in or out of this trade right now, whatever the price may be.
Exactly. It's the fastest way to enter or exit a position, but you don't have control over the exact price you get. On the other hand, a limit order gives you more control.
Okay.
It lets you specify the exact price at which you're willing to buy or sell.
So I could say, I'll only buy EUREST if it falls to 1.1000, but no higher.
Precisely. A limit order ensures you don't buy or sell at a price that's worse than what you're willing to accept.
Okay, limit order sounds a good way to be more strategic about my entry and exit points. Now, what about those stop-loss orders we keep talking about? Are those a separate type of order?
A stop-loss order is actually a type of limit order, but with a specific purpose: to protect your capital. It's an instruction to automatically close your position if the price moves against you by a certain amount.
So it's like a safety net that kicks in when things start going south, preventing you from losing more than you're willing to risk on that trade.
Exactly. And speaking of protecting your profits, there's also a type of order called a take-profit order. It works in the opposite direction of a stop-loss.
Interesting. So with a take profit order, I can tell the platform to automatically sell my position when it reaches a certain level of profit.
Precisely. Take-profit orders are a great way to lock in profits when your targets are met, even if you're not actively monitoring the market.
Wow, all these different types of orders make Forex trading seem so much more sophisticated than just randomly buying and selling currencies. I'm really starting to feel like I can place a trade right now, but I know this is just the beginning of my Forex education. There's still so much to learn.
You're right, we've only scratched the surface of this vast and complex market, but I hope this deep dive has given you a solid foundation to continue your exploration of Forex trading.
I know I've learned a ton, and who knows, maybe one day I'll be placing trades alongside the pros.
I wouldn't bet against it. Just remember the key takeaway we've discussed: stay disciplined, manage your risk, and never stop learning. The Forex market is constantly evolving, so continuous education is essential for staying ahead of the curve.
Great advice. And listeners, if you do happen to become a Forex whiz, we expect a cut of the profits. Thanks for joining us on this incredible deep dive into the fundamentals of Forex trading. Until next time, keep exploring, keep learning, and happy trading.